Most people panic when a recession hits. But what if you could protect your wealth, survive the downturn, and position yourself to make massive profits while everyone else is frozen in fear? Recessions are a natural part of economic cycles. They occur when businesses slow down, unemployment rises, and consumer spending pulls back. The first step to surviving a recession is building a defensive financial mindset. During economic downturns, fear drives people to make bad decisions like panic selling investments or increasing debt. Instead, focus on strengthening your financial foundation. Start by creating a basic emergency fund that covers 3 to 6 months of expenses. You can build it by automating weekly transfers into a high-yield savings account. Next, evaluate your expenses and identify non-essential categories that can be paused temporarily. Subscription services, dining out, and luxury purchases should be among the first to go. The goal is to boost your cash position and lower your burn rate. Track spending weekly using a budgeting app. This helps you see how much runway you have and prevents emotional spending. Finally, maintain job stability. Update your resume, increase your value at work, and network weekly. The stronger your employment, the easier it is to remain calm when markets tighten. The second key to surviving a recession is eliminating bad debt. High-interest credit card balances drain your cash, especially when income becomes unpredictable. To get ahead, prioritize paying off the highest interest rates first. This strategy is known as the avalanche method and saves more money over time. If you carry several balances, consider asking your lender for a temporary rate reduction. Many lenders offer hardship programs during recessions. You can also consolidate debt through a lower interest personal loan to reduce monthly payments. Avoid accumulating new debt, especially on depreciating items like electronics or vehicles. If possible, increase your monthly payments slightly. Even an extra $50 per month can shorten debt payoff timelines dramatically. The most important step is to stop using credit cards unless you can pay the balance in full. Negotiate recurring bills such as phone plans and insurance premiums. Small adjustments can free meaningful cash. Reducing debt gives you more flexibility and decreases financial anxiety during uncertain times. Once your defensive strategy is in place, it is time to protect your income streams. During recessions, many industries reduce hiring or implement layoffs. The best response is diversification. Consider developing multiple income sources. Start a freelance service, sell specialized skills, or create digital products. Even earning a few $100s a month can extend your financial runway significantly. Position yourself as a valuable employee by volunteering for projects, learning software skills, and improving communication. Companies are less likely to release people who solve important problems. Meanwhile, prepare for job instability by curating professional connections on platforms like LinkedIn. Send one new connection request per day and maintain relationships with former managers. If layoffs occur, strong references can shorten unemployment periods dramatically. Stay aware of recession-resistant industries such as healthcare, utilities, education, and essential services. Consider certifying in skills relevant to these fields. Income stability is the single most powerful weapon during downturns. Now we shift toward the profit side. Recessions often present incredible opportunities for investors. Historically, bear markets have led to some of the highest returns when recovery begins. The key is to invest strategically without panic. First, identify high-quality companies with strong balance sheets, consistent profits, and low debt. These businesses often grow stronger after downturns as weaker competitors collapse. Instead of attempting to time the bottom, use dollar-cost averaging. Commit to investing a fixed amount each week or month, regardless of price. This smooths market volatility and positions you to capture upside when conditions improve. Prioritize index funds or ETFs for broad diversification. Dividend-paying stocks can provide cash flow even when prices fall. Reinvest those dividends to accelerate compounding. Avoid speculative bets or meme stocks. They often collapse first. The goal is to accumulate assets, not gamble. Keep your investment horizon long-term and ignore short-term panic headlines. Another profitable recession strategy is preparing for asset discounts. Housing markets, business valuations, vehicles, and equipment often decline in price when demand falls. While others retreat, you can acquire assets at a fraction of their former cost. To do this, increase savings now. Build a dedicated opportunity fund separate from your emergency savings. Study historical price cycles to understand fair value ranges. When the right moment appears, buy quality assets below intrinsic value. For real estate, look in areas with stable employment growth. For small businesses, evaluate cash flow health instead of hype. Avoid over-leverage, meaning do not borrow more than you can comfortably repay. Negotiation becomes far easier during recessions. Sellers become flexible when liquidity tightens. Use this leverage responsibly. The goal is to own assets that appreciate dramatically during recovery. Plan your purchases 6 to 12 months in advance. To truly thrive during a recession, you must protect your mental state. Fear-driven decisions are the primary reason people lose wealth during downturns. Stay informed through credible sources, but limit emotional financial media. Set clear rules for your saving, investing, and spending behavior. Review your financial plan monthly and adjust based on real data instead of panic. Continue building skills because human capital often grows fastest during adversity. Adapt to market changes. If remote work expands, learn relevant technology. If industries shrink, reskill into growing sectors. Commit to long-term thinking. Every recession in modern history has been followed by growth. Wealth is transferred from the panicked to the prepared. By building emergency savings, eliminating debt, diversifying income, and investing strategically, you can survive economic downturns and position yourself for massive financial gains when markets recover. Preparation today is profit tomorrow.